Here we're going to convert from the cash basis to the accrual basis on our balance sheet and on our income statement. And what we do is we start with these four basic accrual accounts, and those would be our deferred revenues and accrued expenses here as liabilities on the balance sheet, and our accrued revenues and deferred expenses here as assets on the balance sheet. And what we have to do is we have to determine the changes in these accounts using accrual accounting, where we allocate our income and expenses to the period in which they actually occurred. And once we determine these changes, then we can compare our cash receipts and disbursements with our accrued revenues and expenses, and then we'd be able to convert between the cash basis and the accrual basis for the revenues and expenses here that we recognize on our income statement. Okay, let's look at how we'd calculate our revenue here on an accrual basis. In our first case will here be our unearned revenue or our deferred revenue. This is where we receive a cash payment in advance of doing any work or earning any of this revenue. So looking at the case here where we received this $6,000 cash advance, we would credit our unearned revenue for $6,000 and then we debit our cash here for $6,000, or our cash would be increased for $6,000. Now this is the case here where we earn less revenue here on our income statement than the cash we received. So to determine our accrual basis here for our revenues, we would take the $100,000, let's say for example we had $100,000 cash basis here for our revenues, so those would be our cash receipts, and then we'd have to subtract out this $6,000 advance payment here, and then our accrual basis for our revenue would be the difference here, $94,000. Now looking at the case here where we had a reduction in our unearned revenue, say by $2,000, so we debit our unearned revenue for $2,000 and then we'd recognize it here as revenue on our income statement, or credit our revenue here for $2,000. Now this is the case where we earn more revenue than the cash we received. So to determine our accrual basis for the revenue, we take the $100,000 cash basis and we'd have to add in this $2,000 worth of revenue that we recognized on our income statement. So our accrual basis would now be $102,000 for our revenue. Okay, let's look at our accounts receivable or accrued revenues. This is the case here where we earned revenue in advance of receiving any cash payments. So let's look at the case where we had a $50,000 increase here in our accounts receivable. So we debit our accounts receivable for $50,000 and then we'd go and credit our revenue here on our income statement for $50,000. And that is where we would have recognized this revenue. Now this is the case here where we accrued more revenue than the cash we received. So to determine our accrual basis, we'd take our $100,000 cash basis for our revenue, and then we'd have to add in this $50,000 increase here in our revenue on the income statement that we recognized, and then our accrual basis would be $150,000. Now looking at the case here where we had a reduction of $10,000 in our accounts receivable, we would credit our accounts receivable for $10,000 and we debit or increase our cash account here for $10,000. Now this is the case here where we accrued less revenue than the cash that we received. So to determine our accrual basis for our revenue, we take the $100,000 cash basis and then we'd have to subtract out this cash receipt that we had for $10,000, and then our accrual basis here would be $90,000 for our revenue. Okay, let's look at how we'd calculate our expenses on an accrual basis. And our first case will be for our accounts payable or accrued expenses. This is where we incur an expense in advance of making any payments. So let's look at the case here where we had a $15,000 increase in accounts payable. So we credit our accounts payable for $15,000 and then we'd recognize it as an expense here on our income statement for $15,000. And that's where we would debit our expenses for $15,000. Now this is the case here where we accrued more expense than the cash that was paid. So to determine our accrual basis for an expense, let's say we had a $100,000 cash basis for that expense, and then we'd have to add in here this extra increase in our accounts payable of $15,000 that we recognized here in the income statement as an expense, and then our accrual basis here would be $115,000. Now to determine the case here where we had a reduction in our accounts payable of $5,000, we debit our accounts payable for $5,000 and then we'd credit or we'd reduce our cash for that $5,000. Now this is the case where we accrued less expense than the cash that was paid. So to determine our accrual basis for this expense, we'd take the $100,000 cash basis for the expense, and then we'd have to subtract out this payment we made here of $5,000, and then our accrual basis here would be $95,000. All right, let's look at our inventory or prepaid expenses, and those would be our deferred expenses here. And this is where we pay for something or we purchase for something in advance of actually using it. So let's look at the case here where we had a $20,000 increase in our inventory. So we debit our inventory account for $20,000, and then we credit or reduce our cash for $20,000 for the cash payment that we made. Now this is the case here where we use less inventory here than the cash that was paid. So to determine our accrual basis, we take the $100,000 cash basis here for that our inventory expense, and then we'd have to subtract this $20,000 cash payment or that increase in inventory for an accrual basis of $80,000. Now looking at the case here where we had a reduction in our inventory, say of $12,000. So we used $12,000 worth of inventory. So we would credit our inventory or reduce our inventory for $12,000, and then we debit or increase our expenses or recognize an expense here on our income statement for $12,000. Now this is where we used more inventory than the cash that was paid. So to determine our accrual basis for our inventory expense, we take the $100,000 cash basis, and then we'd have to add in this $12,000 worth of inventory that we recognized here on the income statement, or the amount that we used here, and then our accrual basis would be $112,000. Okay, to summarize how we calculate our revenue here on an accrual basis, we can look at our cash account. And any increases in our cash account means that we've earned less revenue here on our income statement than the cash we received. So we'd subtract these cash increases here from the cash basis to determine our revenue on the accrual basis. Now in the case here where we had increases here in our revenue on our income statement, this is the case where we've earned more revenue than the cash we received. So we would determine our accrual basis, we'd take our cash basis for that revenue, and then we'd add any of those increases in revenue to determine the accrual basis for our revenue. Okay, to summarize how we calculated our expenses here on an accrual basis, we can look at our cash account. And any decreases in our cash account means that we accrued less expense than the cash that was paid. So to determine our accrual basis for an expense, we'd take our cash basis here for those expenses, and then we'd subtract any decreases in our cash account, and that would be our accrual basis here for those expenses. Now in the case here where we had increases or we recognized increases for those expenses on our income statement, that's the case here where we accrued more expense than the cash that was paid. So to determine our accrual basis, we'd take our cash basis for those expenses, and then we'd add any of these increases, expenses that we recognized here, to that cash basis, and that would be our accrual basis for our expenses.